Today's Hotel Owners Academy is navigating hotel financing, loan document review, and term negotiation strategies with Darshan Patel. I'm going to leave Darshan's email up for just a few moments and introduce myself for those who don't know me. My name is Michael Schwartz. I'm the Programs Manager of Education and Membership Experiences here at AHOA. So, with that said, now I'm going to get into the questions, Darshan. So, first question for you. At what point in the hotel loan process do owners usually lose the most leverage, and how can they avoid giving it up too early?
Yeah. I would say there's two different points. I would say one is during your LOI or term sheet stage first, and the second is going to be your loan documents. So, as we know, very similar to when you're buying a property as well, you're going to start with an LOI or some type of term sheet, and you're going to have your major terms in there, which is going to be the term of the loan. What the rate of the loan is going to be, your prepayment penalty, things of this sort. That's going to be your first stage. That's where you're going to be breaking out, for analogizing it to your purchase and sale agreement. This is going to be similar to like what your purchase price is, what your deposit's going to be, your due diligence time. You're going to find the very same type of deal when it comes to loan documents. And so you want to focus on that part first. You want to hash out as much as you can in that term sheet, because ultimately the loan documents are going to be drafted based on what you agree to in that term sheet itself. So the first step is understanding that, making sure that you're in agreement with what's listed in that term sheet itself or that LOI. And then once you sign that, then getting into the particulars of the loan documents is going to be, a lot of the detail that we'll cover here in today's call. But once you give acceptance on those loan documents, well, then at that point in time, your leverage is out the door. And so you want to focus on your term sheet portion first. I would say 65% of your leverage is right there. And then the remainder is all based on the details in the loan documents themselves.
Gotcha. And speaking of loans, my next question, what is one loan provision that looks harmless on paper but can become dangerous when hotel performances dip?
Yeah, I think I'm going to answer that in two parts. So I'm going to say the most harmless on paper beyond the hotel performance itself is going to be the prepayment penalty. I think a lot of people overlook that prepayment penalty mainly because is most people, when you go into something, are very happy, right? I see this all the time when it comes to franchise agreements, especially if they're signing up a Marriott or a Hilton property. Most people are just docu-signing whatever, comes in front of them. They're not seeing that finer print. Prepayment penalties seems to be that biggest item here because it talks about the quote unquote divorce of the loan itself. Most people are focused about getting in, but not necessarily worried about the coming out. But that's a
Mm.
sizable number, right? If you're getting a $5 million loan and that prepayment penalty is, let's say, 3%, which I see in a lot of cases, that's $150,000. And more often than not, that prepayment penalty is put in there by the lender to protect the lender against their competitors. They want to make sure that you're staying in their loan and not just rate shopping and going to prepay out of that loan as soon as you end up getting a better rate or some better terms from a different lender. And the easiest thing to negotiate for that prepayment penalty is either a cool off or a rundown period, where perhaps you have a 3% prepayment penalty in the first year. And then that sizes down to 2% in your second and maybe third year, and then down to even 1% in your fourth year or your fifth year, and then perhaps falls off altogether as time goes on. The other part that I see in regards to prepayment penalties is in the is for sales in particular. So if you sell your property, a lot of lenders themselves will actually get rid of the prepayment penalty or substantially reduce what that prepayment penalty is if you're going to be selling to a third party, a bona fide third party. And so that's something that a lot of people miss. And I would recommend that everybody keeps that in mind when they're negotiating their next loan.
So,
And
so
then part two, sorry, Mike, to
you're
to
fine.
to answer your original question in regards to hotel performance dips. I think the one thing people miss is in regards to your debt service coverage ratio. So a lot of lenders are going to require either a 1.15, 1.2, 1.3 in certain circumstances where your net operating income has to be that ratio of your debt service. And I think a lot of people miss that because that will put you in default, even if you are paying your loan. And just so we're clear, what we're saying is, say you're taking $1 million in revenue and your net operating income ends up becoming, 500,000. Well, if your debt service itself, and just pulling up a quick calculator here, right? If your debt service itself throughout the year is 400,000, but your net income is, your net operating income is 500,000, well, then in that case, you only have a zero point 0.8 DSCR. And so even if you're paying your debt and your debt coverage ratio is only zero point 0.8, technically you'll be in default if your debt service coverage ratio, comes out to and actually I did that the opposite way around. It actually comes out to 1.25. I'm sorry, I did that opposite around.
That's okay.
But
I'm a horrible math
1.25,
student.
so you're able to pay it, no problem. However, if your debt service coverage ratio is 1.3, then technically you're in default, even if you are still paying your loan. Even though you have 100,000 net income after paying debt service, you're still in default because your debt service coverage ratio does not meet. So just two things in particular. So your prepayment penalty as well as your coverage ratio.
So something that came to mind when you were bringing up the penalties, like, most people are focused on getting in, not getting out, and I liked what you had to say about that because I'm just thinking like if I was buying a hotel or whatever the case may be, and I was so excited, I wouldn't be thinking about the negatives of what could go wrong, or if I ever things weren't working out, how could I get out of it? So is it's more than just not it's more than just reading the fine lines. I guess it's also understanding what everything means and how it's going to affect you no matter what the outcome is. Is that safe to say? I'm just thinking from my perspective.
100%, 100%. And everything that's in those documents pertains to reality in some way, shape, or form. And so everybody needs to understand, what does this actually mean in practice, right? You end up with this 1.3 number and it's just, oh, here's a ratio. And most people just overlook it altogether and they sign on. However, to your point, Mike, is understanding how that actually relates to your hotel's performance and what that number means and what you're actually signing is paramount, because it's in those types of language and documentation that could potentially put your property into foreclosure.
Makes sense. Makes sense. So, my next question for you is, how should a hotel owner think about risk differently when signing loan documents for an operating business, not just a piece of real estate?
Yeah. Uh, Ultimately, we know that debt is what drives growth. We understand that properties can't be purchased 100% cash all the time, and if not most of the time. And so bringing in a lender obviously allows you to, one, make that acquisition that you're looking to make. Additionally, allows you to grow your portfolio in the way that you're looking to grow it. However, as we know, there's strings attached, and those strings are all listed out in those loan documents. And so I know we touched on a couple of them here in regards to debt service coverage ratios. We understand, what that is now, and obviously happy to answer any questions if anybody has any more questions on that portion of it. But primarily, lenders don't want to be in your business. They don't want to take your property over, and I know we'll probably touch on this a little bit more. But understand that the lender is your biggest partner in any deal, right? If you're coming up with 100% of cash, let's just say you have to buy this property for $10 million. Well, you're going to probably put in 40% down, so that's 4 million, and you might have a couple other partners that you're putting together to put this 4 million together. And the same way that you're having that communication with all of these partners here for that 40%, well, don't forget your biggest partner. Your biggest partner is the one that's coming up with $6 million, that's 60%, and that is the lender themselves. And what I tell people is, when you're getting into a loan, treat that lender as your partner, because they're coming up with most money here in this deal, right? Yeah, and most people are going to be taking a loan for 50% or more. And so in that case, stay in communication with those people, have a good relationship, have a good rapport, because as we mentioned, when performance dips or the economy dips, chances are that's going to be the person that you're going to need to call to figure out a way to make sure that you're able to still service your debt.
Makes sense. And we actually have a question from the audience.
Sure.
This one is it good to buy an SBA loan or standard loan if a first-time buyer? And would debt to service ratio also play in any kind of loan?
Yeah. Yeah. Almost every loan, for the most part, I've seen has some type of debt service coverage ratio that's attached to it. SBA definitely does. Sometimes I'll see some private lenders, hard money lenders, that won't have a debt service coverage ratio attached to it. But obviously, that comes with much higher interest rates, where you're probably looking, above double digits, so above 10% in terms of an interest rate if you're taking those types of loans. In terms of what's best, it really is going to depend on a case by case basis. what terms that are being offered. I will tell you that SBA does have favorable loan terms. However, they are a lot more strict and a lot more stringent when it comes to their loan process, and likely takes longer as well than trying to go through just a conventional loan through a local relationship bank.
Gotcha, gotcha. And just want a quick reminder for the audience, the chat box is open, so if anyone has any questions, feel free to chat in and I will ask Darshan. But on to my next question. When a lender says a provision is standard, what should borrowers still push back on?
Yeah. every okay, most lenders have their quote unquote standards, and those standards are quote unquote deal breakers, which means that if you don't agree to them, well, then in that case they're not going to offer you the loan. Let me give you an example. There's one lender that I know that will always attach a 0.0098% to every interest rate. It's just part of what their terms are. So I'll give that to you an example. So if the rate is agreed rate 6.21%, well, now it's 6.2198%, right? And so that's how they do it, which pretty much functionally they're adding a hundredth of a percent to the interest rate themselves. That's just what it is. And that's their deal breaker, where if you don't accept that 0.0098%, well, then in that case, they're not going to give it to you. Well, what I say is you take that deal breaker and you try to find that loophole around it. Well, if that's your standard where it has to end with 0.98%, well, then reduce my rate. Reduce my rate by 0.01% and then attach your 0.98% onto it. So if the initial rate was 6.21, I would say, okay, well, now make it 6.20 and then add your 98 behind that. So it effectively still becomes the same thing. So it's 6.2098 as opposed to 6.2198. And so it's these kind of things that you can work with their quote unquote deal breakers, that you just try to find that loophole where they have a certain standard, figure out the other way around it so you're able to achieve what you're looking to achieve as well as what they're looking to achieve. But there are certain standards, for example, that the bank just won't push on. I see this in the personal guarantee section sometimes. I see this in the prepayment penalty every so often. I see this in regards to origination fees and so on. And when those come up, for the most part, everything is negotiable. But if they come up and they end up having some type of deal breaker, especially if it's a money related deal breaker, find the money in a different area, right? Let's say, for example, that they're saying their origination fee has to be 1% or has to be 1.5%. Fine. Don't mess with them on that. Figure out what that amounts to in terms of dollars. If you're looking for a $1 million loan and your 1.5% comes out to $15,000, well, find that $15,000 somewhere else, right? If they're charging you a legal and loan document processing fees and that's 30,000, ask for a discount on that 30,000 to 15,000 or to 20,000 to make up for it. Because at the end of the day, it's just all dollars on the spreadsheet. You only really care about what that bottom dollar is in terms of the total amount. So work through that process. And if you can't fight them on something here, fight them on something else somewhere else. So it all nets out to
Yeah.
what you're looking for.
Yeah, makes complete sense. And we have another question from the audience. What are
Sure.
some line items that can be negotiated when it comes to SBA loans?
Yeah, I guess if there is somebody that's very strict in regards to their SB, in regards to loans themselves and their deal breakers, it's going to be the government. And we can, we can say that pretty much across the board, where what the government's rules are the government's rules. There will be an originating bank that's going to process that SBA loan. Most of your negotiations are probably going to be with the originating bank more than with the SBA, because for the most part, the SBA has to be fair across the board, which means that they can't do something for you that they're not doing for somebody else. So what the SBA is saying, the SBA is has to do kind of across the board, and they have to have a blanket policy when it comes to that. So there are certain items that you can go ahead and negotiate. Terms are going to be very difficult to negotiate with the SBA, but you can negotiate with the originating bank, right? When you're getting a loan from the SBA, you're not going directly to the Small Business Administration. You're going to go through some type of regional bank, or you're going to go through, perhaps even an institutional bank in order to get that SBA loan. So your negotiation is primarily going to be with that bank more than it's going to be with the SBA.
Understood. So another question from me is, what are the biggest mistakes hotel owners make when reviewing guarantees, especially personal guarantees?
Yeah. Yeah. Corporate guarantees are great, and you try to stick in the corporate guarantee realm as much as possible. However, lenders are savvy people, and so they understand that, at some point in time, somebody can just close up a bank, an entity, and then close down that corporation, bankrupt that corporation. Their liability just stays stuck in that box itself. And so now they've attached, personal guarantees. Personal guarantees have been around for decades here now, and a lot of people accept them. To your point, where they're just thinking they're boilerplate and they sign them. They're not always boilerplate. I would say a lot of them are, and a lot of them probably fall into that standards deal breakers realm as well. However, there are some caps that you can put into those personal guarantees, and this just goes back to the relationship with that bank itself, where you can go ahead and cap that, right? Understanding what your personal financial, status is, understanding what type of loan that you're taking in terms of dollar amount. There probably is something you can negotiate, and some of these work, some of these don't. But I always say that when it comes to negotiations, whether it's in loan documents, purchase sale agreements, lease agreements, and so on, you always ask, right? You always ask, and you ask forcefully, where it's almost a tell, because the worst they could say is no, and if you don't ask, it's a guaranteed no. And so you want to try to put those caps in wherever you can, especially when it comes to your personal guarantees, because last thing you want is to be fully on the hook for any loan that you're taking out. And so try to put some type of cap on there where, if you're paying for X number of years, that every year that goes by, there's X percentage that comes off of, what the actual liability is that you're holding personally.
Gotcha. Thanks for answering that. So then the next one for you is, how can cash flow covenants or debt service requirements quietly control the way an owner operates the hotel after closing?
Yeah. Yeah. This goes back to what we were discussing here a little bit earlier as well. And what I tell people is, when you're getting into a property, for the most part, you're doing at bare minimum, you're doing some back of the napkin, pro forma operating budget to see how you're actually going to survive, right? You're saying, here's the revenue of the property. Perhaps you're increasing revenue by X percent or X dollars because you'll be a better operator than who was there previously. You'll go ahead and you'll run through, here's your general payroll, your general supplies, property taxes, utilities, insurance, etc. And then you're coming down to that NOI number that we discussed. And then, we're talking about what debt service is, coming up with your debt service coverage ratio, and that's all fine and dandy. What I tell people that they need to be doing now is they need to be putting their pro forma, their budget, under a stress test. They need to put it under a stress test because you just don't know what's going to happen, right? And what I mean by stress test is, if you think that you're doing, $1 million in revenue at this particular property, you need to function and run some type of analysis to say, well, what if your revenue becomes 900,000? What if it becomes 800,000? I would even go as far to say, what if it becomes 600,000, and see what ends up happening to the actual financials here. And then that's the way that banks do stress tests on their side as well. So that'll put you kind of ahead of the curve when you're actually applying for that loan. That if the worst should happen, if another COVID should hit and your revenue drops 10, 15, 20, 30, 40%, where is that sweet spot where at least you're going to break even? And then where is that spot where you're going to break the gate? Right? Where does the dam end up breaking where your property just cannot function if you're not making X number of dollars? That's the analysis that everybody needs to perform, so that they're aware of where they actually are when they're signing up any of these loans. Because the last thing anybody wants here is for their property to be taken from them. And so you need to know what the minimum dollars are that you need to make in revenue in order to make sure that your property stays solvent.
Gotcha, gotcha. So I have another question from the audience. This one's a little longer, so I'll read it, and then if you want me to kind of just break it apart, however it works for you.
No
So
problem.
the question: normally in hotel industry, valuation they consider is 3 to 4 times the revenue for which banks will value and issue the loan. But many research reports says revenue will decline every year, especially with AI and layoffs in the play. Who decides such fair valuation? The banks, the seller, or the buyer? i.e., to pay 2 or 3 or 4 times the revenue and loan related to it?
Sure. So here's how I'll answer that. The value of anything, this goes back to the beginning of time, is what a buyer and a seller are willing to agree to, right? I have my phone here, right? I agreed with Verizon or whomever that I'll pay X number of dollars for this phone. So that's what the value of this phone is, right? That's just from a general standpoint. Now, as we get specific to loan docs, the value is going to be dependent upon what an appraiser values that property. That's what lenders end up using as the value of a property. So most times what I'll end up seeing in regards to that term sheet that we're going back to is that the lender will come up and the borrower will come out and ask for $3 million. So the term sheet will almost always say that the loan amount will be the lesser of $3 million or 65% of the value of the property based on third party evaluation. And then what they'll do is they'll go out and they'll, get a list of appraisers. They'll show it to the borrower and they'll say, okay, which appraiser do you want to go with? They never show the names. They only show what the turnaround time is going to be and what the amount of that appraisal, the cost of that appraisal is going to be. Buyer chooses one, appraiser ends up coming out to the property, does a site visit, ends up checking a variety of different items, and then comes up with their value. Now, yes, back of the napkin from a revenue multiplier standpoint. Yes, I know that's a lot of ways of people end up valuing property, but that's just one way. So the other couple ways that people value properties is going to be on a cap rate approach, which will function on that net operating income that we referred to earlier. And then they'll take, your standard cap rate for hospitality and that type of asset and that submarket, and then run the calculation accordingly. And that can be anywhere between 7, 8, 9, 10% cap rates. And then the other one is going to be replacement costs that, in the event that somebody needed to rebuild this property and build it up from ground up, what would the cost be? And then obviously there's the comps approach as well, where they'll take a look at properties that have sold in your area that are similar to the type of property that you have. So there's varying ways that you can value a property. There is the revenue multiplier, there's the cap rate approach, there's the replacement cost approach, there's comparing it to comps as well. And then the appraiser will then take all four of those different analysis and then come down with a conclusion of this is what they believe the value to be. And that's the value that the lender will actually rely on. So to answer your question in a very long-winded manner, it's going to be the lender will go off of whatever the appraiser says.
Gotcha. Thank you for the elaborate and then consolidating it into one sentence. So that's okay, super awesome. Next question for you is what default provisions can turn a temporary business problem into a major legal or financial crisis?
Yeah. The biggest one, right, is just not paying your debt. And we know for the most part, your debt service needs to be serviced on a monthly basis. That's your biggest one. And more often than not, at least the rule of thumb is that if there's one person you need to pay every month, that's your lender, right? I feel like a lot of people miss that understanding. And I understand that sometimes when times are tough, you're just not able to make money work. Well, if you don't have money to pay, then you don't have money to pay. But going back to what I said earlier is don't go dark. Don't try to hide behind a rock and hope that the lender doesn't catch you.
Yeah.
Come out into the light, right? Because they're going to catch it. This is what the lender does day in and day out, right? They lend money and they collect money for interest and principal. This is what they do. It's just a matter of time until they do, and chances are that matter of time is going to be a lot faster than what you're hoping for. So it's better for you to just make that call. And this goes back to that relationship that I'm telling you to make sure that you have with all of your lenders is that if you make that call and you call up Jim at XY Bank and you tell them that, look, this is the issue that I'm having. What can we do? Is there a way that we can restructure the loan? Can we go interest only for 6 months to get me out of this funk that I'm currently in? Let the economy come back. There's this group that I have coming in that was supposed to come in this year, but they're not coming in till next year. Work with that lender because as I mentioned, the lender does not want to issue you a notice of default. They don't want to go through the foreclosure proceedings. They don't want to take your property over because these are bankers. These are bean counters. They are not operators. Last thing they want to do is appoint a receiver to take over your property and try to function because we know a receiver is not going to be able to operate the property better than the operator that is currently in place, better than that buyer. So work with your lender. Don't go dark on them. Show that you're being upfront about it. More often than not, they will work with you because they know that they'll get more money working with you than if
Mm.
they end up appointing a receiver to try to get the money themselves.
That makes complete sense. And, I know it's kind of a cliche, but in any healthy relationship, the number one key ingredient is trust. So I completely understand the going dark. It's like you're not gonna, and also goes back to what we were discussing of we don't think about the negatives of exiting and perhaps not everybody, but I know some people out of fear or whatever, they don't make the best decisions. And to your point, what I keep on hearing throughout this is transparency is key because you know they don't they're not the boogeyman. They don't want to destroy your dreams, so to speak. So yeah, this is makes complete
And and
sense.
and, and I'll follow up on that, which is, 98% of the lenders out there will work with you, right? Most of them, like I said, are bean counters. They're not hotel operators, they're not hotel owners, and they don't want to be either. And this goes back to what I was saying is that they are your biggest partner. Chances are they have more money in this deal than you do. They have 60% and you have 40%. So be communicative, right? Imagine if you were on the other side and you lent money to somebody else and they didn't end up paying you, your monthly payment. How would you feel? That's the way where you need to put your feet into their shoes and understand that. And then at some point, they do have to engage legal if you're being non-responsive. And so understand that you would do the same thing if you were in their shoes, because a lot of people I've seen, a lot of my clients have lent money to other people, especially when they're first starting out. Sometimes they're giving it to them as a gift. Sometimes they're giving it to them as an actual loan with terms and payments to come back. So just keep that in mind and understanding their perspective as well, because, I can understand that a lot of people think of them as the big bad boogeyman under the bed, but most of the time they are not. Now, as I said, 98%. There are 2% of those lenders that are out there that are predatory lenders, that they
Yeah.
do structure their loans in a way because at some point they want to take over your property. So they're actually hoping you fail. And those lenders do exist. So let's not skirt ourselves away from the realities of the world here, because those types of lenders are out there as well. But predominantly, if their focus is primarily in banking and they're not hard money lenders, it's usually the hard money lender types that I will see as the more predatory lenders. But if they're just a standard, traditional, conventional community bank, regional banks, things of the sort, those people are the ones that are wanting to work with you.
Gotcha, gotcha. And another question from the audience is there a way to negotiate the collateral clause in the agreement by limiting certain assets used?
Are we referring to personal assets or are we referring to corporate assets? If that person wants to give me a follow up.
Yeah, I'll let them both.
Oh, good. Um, yes, I see it on personal. Well, let's start with corporate assets first. Corporate assets, probably not. For the most part, if a lender is loaning money to that corporation for the purpose of X asset, chances are they're going to want everything that's involved with that asset. That includes all the furniture and fixtures. There's going to be some kind of UCC filing that says that all the property in terms of the FF&E that's in that building is also all part of and tied to this loan as collateral. On the personal side, I would say yes, from a limiting standpoint. This kind of goes back to that personal guarantee that we're referring to in terms of limiting what is actually able to be foreclosed on or at least defaulted on. I know a lot of times lenders will go ahead and put a hands-off provision on homes that are owned. So at the very least, your homes will be safe in the event of default. So that's something that you can always negotiate in your personal guarantee. I know a lot of, especially for the community lenders and the more regional lenders, if you have a good relationship, chances are they will exclude any personal homes from that personal guarantee.
Gotcha, gotcha. And another question, and apologies if I mispronounce this word or I am not explaining it correctly. Aside from force majeure, what other borrow-friendly terms should be included?
Yeah, so force majeure is a great Latin phrase which directly translates to act of God for most part. It was something that was taught in law school a lot and really came into effect when COVID occurred, to see was COVID actually an act of God, was it not an act of God, and a lot of force majeure clauses, just so we're understanding that for everyone else on here, is a force majeure clause will more often than not terminate the agreement or at least allow for provisions to provide greater flexibility in the event of something like that happening. Most force majeure or acts of God are primarily going to be natural disasters. So we're talking hurricanes, tornadoes,
Tornadoes. Yeah.
storms, things of the sort.
Gotcha.
However, now with COVID and more medical items coming in is now being really thought about. So anyway, back to what we were discussing in regards to whether force majeure comes into effect. I would say yes, it does. I think that every loan document now needs to have some type of force majeure clause in there, but a broader force majeure clause that affects the economy at large. I think what you could also put in there are going to be, federal disasters or federal emergencies. Because what ended up happening, especially when it comes to COVID, is I'll give you a quick example that a lot of insurance policies had the force majeure clause in there that say in the event of some type of force majeure issue, that the policy will not be covered in certain cases. There are some where they will cover force majeure, some will not. And the argument came on, is COVID actually force majeure or not? Is it an act of God or is it not? And a lot of insurance companies use that ambiguity to skirt their responsibilities to provide insurance, and primarily for loss of income. And what ended up happening is, as we all know, the world shut down when COVID happened. A lot of revenue ended up dropping, 30, 40, 50, 60% in certain cases, if not greater. And a lot of those cases, the hotel owners ended up filing an insurance claim for loss of income due to this issue. And so then the question came up is to say, was COVID force majeure or not? And so what I would answer to this question is that you go beyond force majeure, go in there and put federal disasters, federal declared disasters, federal declared emergencies, because at the very least, if it doesn't fall under force majeure, we know that there was a federal declared emergency when it came to COVID, and that will end up capturing any of these types of issues that are not in there. So in terms of protections, that's definitely something I would put in. Other things that you can put in is you can put in more economy related items. So, like for example, in regards to recessions, you could put in, if there is a non-property specific drop in revenue of 30%, that in those cases that a particular clause or special provision ends up getting triggered that allows for, I don't know, 6 month interest payments or interest only payments, or 3 months of no payments, and the interest and principal ends up getting attached to the back end to the balloon payment. What I would recommend is in these cases, and this goes back, this actually was something I was going to talk about a little bit later, so I'm glad that this question came up, is you want to include as many options as possible. And it ties on to what I said earlier, whereas if you don't ask, the answer is always no. And so you want to include as many of those safety provisions as you can that can get triggered at a later point in time, so that you're safe. And a lot of times the lender, as long as it's reasonable, will agree to them because they're expecting that it will never happen. In the event that it does happen,
Yeah.
well, then they're probably going to want to comply and help you anyway, so they're okay putting that in. So for example, if I had to give you some specific language, I would say, in the event that our star report shows that there is a 40% drop in RevPAR year over year, that the borrower has the ability to execute or to execute an option for 6 month only interest payments, and principal will still accrue and will add to the balloon payment that gets paid at the end of the loan term itself. So there's a very packaged language that I would say that you could add, and then you can use your logic to say other types of issues that could arise and what types of information and types of allowances and flexibility that you would actually want. I'd put those types of things in there.
Gotcha. And four more questions came in while you were explaining all that. So
Bring them on.
yeah, I believe you answered this, but I'm just going to say it anyway. I think this was a follow-up from that previous one, which was to elaborate what other terms clauses would be borrower friendly to be included in a loan agreement. I believe you covered that. I just want to, okay. I just like to do my due
Yeah,
diligence.
if anything else comes up while we're talking, I'll go back to that question and answer those as well.
Awesome. Okay. So the next question is, how is additional funds structured to be drawn on in the future? What are some of the pros and cons around this?
Additional funds to be drawn on. Are we referring to like a construction loan, or are you referring to a conventional that maybe has some type of additional PIP money that could be allowed if there's a performance standard that gets met? Need a little
Um,
bit more information on that one.
yeah, I'm gonna let them chime in.
How about we move to
Addition,
the
additional
go
PIP.
additional PIP? Sure. Uh, and sorry, can you repeat his question
Yeah.
again? The
Yeah,
initial.
yeah, absolutely. So it's
No
how is
worries.
additional funds structured to be drawn on in the future? What are some of the pros and cons around this?
Yeah, this is a good one, and I'm gonna toss in construction loans here as well, just to have that conversation because they merge together well. Is that we know that in a traditional construction loan, for the most part, or perhaps we don't know, but we'll put in a quick 60-second nutshell, is that you may get a loan for $20 million to build your Hampton or Courtyard, whatever it may be. They're not going to give you a lump sum check for $20 million and say spend it wisely. What they're going to do is they're going to break that out into stages. And that stages are going to depend upon what you're doing in construction itself, right? They want to make sure that you've completed your foundation work, you've completed your grading. Once you do that, what they'll do is they'll probably send somebody out from what's called funds control, which is a third party that will actually manage the construction milestones themselves. Funds control will then go out, take a look at it, make sure that the grading is actually complete, take a look at all of the inspections that the city has performed, and so on. And then they'll go ahead and release money. And every stage of construction, they'll release money accordingly. Now, the way that they release money, how they release money, the notices that need to be provided, how much time goes by, all of that is negotiable. And this is what comes back to the initial question in regards to the PIP, is it depends on when and how you negotiate that in your loan documents, right? So, for example, if you're buying a property, chances are if it's a franchise property, you're going to have some type of transfer PIP, right? New owner comes in, that's when the franchise loves to toss in a new PIP to refresh that property. Chances are you're going to negotiate to say that you're going to complete this in the next 12 to 18 months. Well, then in that case, and during that 12 to 18 months, there probably is some type of design review period. If this is a custom property, it may take a little bit longer. If it's a prototype property, then it could be a little bit shorter because you've got a predefined scope of what you're going to need to do. And usually the brands and franchisors themselves will provide you the suppliers that can give you that can give you and supply those actual FF&E goods. So anyway, what you'll do during those times is you'll negotiate with the franchise with the lender to say, you need X number of dollars for the actual purchase of the property, you need X number of dollars for your PIP, and I would break them up into segments, right? Because there's likely going to be deposits that you'll need to put down while your FF&E is being manufactured. So I would make sure that you have at least money during the deposit period. There's likely going to be money that you're going to need to do in prep work for your contractor to go ahead and demo out everything that needs to get demoed out. So I would have money ready for that. I'd have money as well for when you actually receive the goods and you need to make cash on delivery payments. And then you'll end up having perhaps maybe two more milestones in there as there's progress payments that need to get paid to your contractor as they complete the PIP itself. So to answer your question, very long-winded manner, is it's going to be up to negotiation. Work with your contractor, work with whoever's doing the work itself, work with whoever the suppliers are to understand what the timeline of milestone payments are that need to get paid to both the contractor as well as the suppliers, and then break that out with the lender so that you get the money accordingly. So you're not coming out of pocket and that the lender is actually loaning you that money while you're needing it.
Awesome. Thank you for answering all that. But I still got more questions from the audience. So,
Go ahead.
next
We've got
one
time.
is my hotel has a CMBS or yeah, CMBS loan. I am converting it to IHG from Best Western. I want to get an UCC loan to help the conversion expense of FFE since CMBS, challenging me on my alphabet here, does not help with the new money. Do I need to
Sure.
tell CMBS about the UCC furniture loan?
Yeah. So CMBS loans, collateralized mortgage-backed security loans were very popular pre-COVID. And just quick 60 second on CMBS loans. For the most part, CMBS loans were, these mortgage-backed securities, which we're all aware of. They're back from the recession when they were really frowned upon, but they were good loans for people because they were low rate. They were 30 years or 20, 25 years, fully amortized. They were non-recourse, which means that you didn't have personal guarantees. There were always bad boy provisions, which means that if you did something, not necessarily just wrong or fraud, but if there were defaults, then technically there is a trigger for personal financials or personal guarantees. But they were very good loans in that way, right? People were getting low 4% loans, refining out, being able to even pull out cash in certain ways, and they were fully amortized over the entire course. And there were non-recourse, which means you knew your personal assets were going to be safe. That being said, you're converting to IHG. You are needing a secondary loan. You want to get a UCC loan, that's fine. That loan document, that CMBS loan document is likely 60, 70 pages long. It's if not longer. CMBS loans are known for being very thick because these are Wall Street backed loans that need to be fully protected in order to quote unquote make them safe. So I have no doubt that somewhere in that provision of this much paper that there's going to be a document in there that's going to say, if you decide to put any further leverage on this property, we need to be notified. I have no doubt that it's in there somewhere. So yes, you're going to need to notify whoever your servicer is for your loan that you are getting this secondary loan. Chances are you're going to have to go through some type of approval process. There likely is a chance that you're going to have to get an appraisal done to find out what the value of your property is, find out what the CMBS balance is, find out what the UCC balance is that you're looking for, and you're likely going to have to come under a certain leverage ratio. So somewhere, like I said, in that thick package is going to be something in there that's going to say, in the event that you're trying to further leverage this particular property, we need to draft third-party appraisers, and you cannot exceed 60% or 65% of what the value of the property is by putting on a secondary mortgage.
Thank you for answering that. Two more questions from the audience. So one of them is, do you mind explaining the non-property related 30% drop situation, please?
Yeah. So non-property related primarily means that the 30% drop that you have in revenue is not your fault. It's not because of bad management. It's not because of bad revenue management. It's not because you got kicked off of booking.com for not paying their expenses. It's macro. It's globally related. That's outside of what you're able to control. This goes back to, use COVID as a perfect example. There's nothing you could have done to prevent COVID from affecting your revenue at your property. So that's what I mean in terms of non-property or non-operating related incidents in that way, right? And we're talking natural disasters, we're talking about pandemics, we're staying in that realm of things. Even the recession, I would even say, for example, going back here 16 years or so, when the recession happened and we ended up having drops in revenue because people just didn't have enough discretionary income to travel as much. I would say that that's also non-operating specific or non-operating related, where that doesn't affect you. And I think the biggest way to tie that is the lender is going to say, well, how do we determine whether it's property specific or not, is that you bring in your STAR report and you take a look at it, right? If your entire comp set, with you and your minimum four competitors are all suffering the same amount, chances are it's not because you all have bad management. It's because there's something happening with the entire economy.
Gotcha. Makes sense. Another question from the audience is how to structure line of credit with existing bank.
Yeah, that one's relatively easy. That one is just a conversation. This goes right back to those relationships that we were talking about. And I love lines of credit, right? I think lines of credit gives a lot of flexibility to a lot of people without necessarily having to hold you down with a formal mortgage, right? Lines of credit usually are going to be personal lines of credit, unless you have a corporation with multiple assets in there and strong financials. I don't really see too many corporate lines of credit. And if they are, they're usually tied to some type of personal guarantees, so it almost functions as a personal line of credit. Long story short is lines of credit is just a conversation. I think structures can be in multiple ways. I've seen lines of credit that are evergreen where, they'll open up $1 million line of credit and it stays open for as long as you want it to stay open. Perhaps you're paying, a small maintenance fee every year just to keep it open. It could be, $800 for $1 million line of credit, and you pull on it as you need. And you pull $100,000 out. There's a set rate. Sometimes that rate is floating. More often than not, especially if it's an evergreen, line of credit, it's going to float. It's going to be tied to either the 5-year treasury or prime rate or something to that effect. And depending on when you pull it, depending on what that math comes out to, you pay on however much you pulled on whatever that current rate is at that time. Then you have your fixed terms lines of credit, which are for 1 year, 2 year, 3 years at times, for X varying of dollars. Sometimes those can be fixed, where you can get a 7% fixed rate line of credit for 3 years, and you pull on it as you need, and you replenish it when you want, and you pay interest as needed, and depending on how much you pull.
All right, thank you for answering that. And now on to one of my questions. How can hotel owners negotiate loan terms that give them room to survive market downturns, brand issues, renovation delays, or even revenue drops?
Yeah. Yeah. And I think that goes right back to a lot of the things that we've discussed here already today is, putting in those provisions in regards to, economy type disasters, even if it's, federally declared emergency disasters, putting in as many of those safety provisions as possible. I know a lot of the things that we're discussing, or at least we discussed earlier today, we're saying, look, if you're already in a loan and you're having an issue, go talk to your lender, maintain that relationship, leverage that relationship, see what you're able to get out of them. Same thing, except now you're going to do it prior to signing the loan, so you put it into the loan documents themselves, so you have that extra security where let's just say this is a 5 year, 7 year, 10 year loan. If something happens, you're not having to go and ask for them and hope that they're going to be forgiving and merciful, but instead you have it in your loan document as a provision that you're able to execute whenever it is that something like that ends up getting triggered.
Makes sense. Another question for you would be, what lender remedies should owners understand before signing, not after a problem arises?
Get that to me one more time, Mike.
Let me give you that. So, what lender remedies should owners understand before signing, not after a problem arises?
Sure. For the most part, lender has two remedies. Well, there's probably more than two. Your big ones are going to be the recapture provision, the acceleration clause, which means that in the event of default and notice of default and lack of cure, so say for example, there's something you defaulted on, whatever it may be that's in the loan terms themselves, they'll issue you a notice of default letting you know what your default is. More often than not, there'll be some type of cure period, 30, 60, 90 days to cure this issue. In the event that you don't cure that issue, then what ends up happening is there's an acceleration clause that usually comes up, which means that the loan is full and due and payable, whatever your loan balance is, which usually is a hefty number, is payable within 5 days, 10 days, 15 business days. So right off the bat. The other one is default interest, that in the event of default, that your loan, the interest rate just skyrockets. And I mean, that can easily go as high as 13, 15, 17, 18% in certain cases. And then lastly, which is the big one, is that, under notice of default, there could be a foreclosure provision that ends up coming into place. And then, the bank ends up going through a foreclosure and they ultimately sell your property to make up the loan amount itself. So those are the three remedies that I see lenders end up putting in more often than not. And the way I guess you can protect yourself from that is talk about cure period. You can end up increasing your cure period. So if it's only 30 days, get it up to 60, maybe 90, even 120 in certain cases, depending on what it is. Chances are they'll break it out and they'll say, okay, hey, look, if you haven't paid your monthly debt service, we're not going to give you 120 days to pay it. So that'll be shorter. But if you're defaulting in something else that's, perhaps property related, then maybe they'll give you a little bit more time. So they'll give you different cure periods depending on the type of default it is.
Gotcha. Well, I've got one more question from my end. I did want to give the audience one final opportunity to ask any questions. A lot of good questions today. Always good to see participation in that forum. So I'll just open the floor for just a few moments, see if anybody has any additional questions to ask you, and then I'll ask my final question after I give everyone just a few moments. I know that
Sure.
there are a lot.
Yeah, and while they're typing up what they're typing up, another thing that I'll see, especially when you're buying a property, or even if it's a construction property, and you've completed construction and now you're ready to get either a bridge loan or a mini perm or even a perm at that point, is negotiating some runway, right? You're going to need to stabilize, especially if you're buying a distressed asset as well. There's not enough revenue on the books already, and you're going to need to revamp. Perhaps there's some type of renovations that you're needing to do. You could probably build in some type of interest reserve as well, where you're getting maybe a slightly higher loan, and ultimately the loan is paying itself back for the first 3 months. And then maybe after that, you end up having another 6 months of just interest only. So you're not having to pay back the principal during that time. And so then that gives you like a 9 month runway, 3 months where the loan is paying itself through the interest reserve, 6 months where it's only interest only. So it gives you a 9 month kind of ramp up while you're doing any type of renovations, more efficiencies and maximization in the operations, things of that sort as well. So all things that you guys can always think about when you're buying property as well. And a lot of lenders are open to that because at the end of the day, they don't want to throw out the baby with the bathwater, as it were. They don't want to give you this loan just for you to fail within the first year. And if you explain the story, and I think that's where a lot of people miss, is that at the end of the day, on the other side of the table, when it comes to the lender side, is they're still human beings, right? Yes, they're looking at numbers, they're looking to see if it all values, but your job as a borrower is to build that story. And if you're going through a loan broker, it's their job as well. So, but they need to be armed with that story. And what I mean by that is tell them what's going on at the property and why you think you're going to do better, right? For the most part, people are buying properties not because of the way that they're functioning, but primarily based on the way that they think that it will function once they take over, right? They think they'll be better at revenue management. They think they'll be better at expense control. They think that they'll do a lot better when they think they'll do a lot better when they do a renovation or they do a brand change. I know somebody said that they were switching from a Best Western to an IHG. So tell that story, right? Tell that story. The reason you're buying the property, whatever reason that is for you, that you think it's a good investment, you need to build that same story and make sure that your lender is aware of it. And that's where two things will end up happening. One, chances are if you build that story, the lender will then buy into that story and make it easier to go through loan approval committees. And then second, if there's these asks for this longer lead time and this ramp up, chances are they give it to you if they understand what exactly you're needing that for.
Makes sense. So I knew this would happen. Two more questions came in, and we'll
Go
we'll
ahead.
we'll end we'll end it with the
No, I've
last two
got time.
questions.
I've got
Okay.
time. Go ahead.
Awesome. So one of them was what construction loan agreements should be included, question mark, and then in parentheses it was borrower friendly.
What construction loan agreements should be included borrower friendly? Got it.
Yeah.
I'm assuming by loan agreements, he's probably referring to like loan provisions. What I would say in that is focus on your timing and your notices. I don't think there's any particular provision that I would say you definitely put in there. But what I would say is, understand what it takes to actually request funds. Understand what type of documentation. I would try to attach a form because what ends up happening more often than not is it's just written out in just block form as to everything that needs to be included as part of that notice. What I like to do is I like to attach an exhibit to say here's the form that we're going to fill out every time that we want to draw funds. So now there's just no argument as to what the form of that looks like when you send it in, right? So include that form. So you just fill out that form, you send it out. Other things is that when I would definitely have extensions in there. Construction is always late. It's always late. I've never seen a construction project that's finished on time and on budget. If it's on time, it's probably off budget, and if it's on budget, it's probably off time. So have that leeway where you have an extra 6 months extension. So when you're in the middle of construction and your loan ends up running out, you're not paying interest out of pocket, one, and then two, they're not asking for full payment to be had when your property isn't even done yet. Because I don't know, 95% of the time, I never see a new lender want to take on a loan in the middle of construction. So if you have to do a refinance in the middle of construction, that's a very bad position to be in, because chances are you're going to have to go out to either one of these hard money lenders, or like I said, one of these predatory lenders that are the only options that you're going to have, that are going to have very high interest rates and very bad terms that aren't going to be too favorable to you. So a couple
Gotcha.
things that I would add to a construction agreement.
Thank you. And this is a two-parter. This person is asking, so can I have you as my counsel for my new potential construction loan? That's
Sure.
what that's that's why I have left Darshan's email address up. So feel free to get in touch with them. But the second question is today's finance market friendly to new build? And we'll end it with that one. Or is that a loaded
Yes
question?
and yes and no. Yes
Yeah.
and no, right? And the answer is always yes and no. The answer is always yes and no, and I'll tell you why, right? It's yes, depending on one, who the lender is. And I think that's the first question, is who is the lender? Because certain lenders right now just have a moratorium on new build hospitality. They think that the market is oversaturated at this point. They don't want to get in on it. They've either had horror stories of their own. They'd rather get into performing assets that they know are cash flowing right off the bat. They know that they're going to, make payments here next month. So there's certain lenders that are just completely no on new build hotel construction at this point in time. And then there are lenders that are maybes, right? And the maybes always come down to, where is it? What is it? How long is it going to take to build? How much is it going to cost? And so it really is a case by case basis, right? They're going to take a look at the market. They're going to see, is it oversupplied? They're going to pull STAR reports. They're going to want feasibility studies, which you can get from CBRE, HVS, to name a few. And in there, it'll have a full breakout, right? You always remember that bankers don't know anything about the industries that they're lending in, right? So they don't know what's happening in the hospitality industry. So there's two things that end up happening. One, they need that story, as I mentioned, from you as to why do you think this is good build, and you need to be able to provide the evidence behind it. And then two, they're going to want a third party report, right? They're going to want some type of feasibility study to prove that what you're saying is not make believe and that it actually is real.
All right. Thank you for answering that. And then I promise this is the last. It's just I would feel badly if I left this last one.
Go ahead, go ahead.
And then for everyone attending, we will have to conclude after that. I would love to do this for another 2 hours, but unfortunately, it is what it is. So, would you help with the loan agreement, even if you're not licensed in that state, if it does not involve you negotiating with the other closing attorney? I feel like this is one of those get in touch with you via email answers.
Yeah, yeah. We're just so you know about our law firm is that we're licensed for transactional work throughout the entire United States, and so it's only for litigation matters that it becomes a little bit more state specific. But majority of our states are covered here as well. But yes, to Mike's point, send us an email. My email's up here on the screen. That goes for anyone here. If there's any other questions that we weren't able to answer on this call, feel free to send me an email. We're happy to get back. We provide a lot of free education. So if you're dropping us a couple questions and you just want some advice, we're always happy to do that without any cost. And then of course, if you want to look at our services and want us to review anything that you're currently working on, or even help you negotiate any of your loan agreements, we're happy to do that for you as well. There's a segment of our firm that even does a little bit of loan brokerage as well. So if there's any needs in any of those fields, feel free to send us an email and we'll get right into it.
Awesome, awesome. Well, Darshan, as always, thank you so much for joining us. This was super fruitful. Lots of great questions from the audience, and I'm sure we'll have you on another time. We had you on several times last year. Love always talking with you. Always learn something new. So for everyone who wants to get in contact with Darshan, his email is up on the slide. And if you want to get in contact with me, my name is Michael, and email is super easy. It's just michael@ahoa.com. So tune in next, I think the 23rd is our next one. So July 23rd will be the next webinar for the Hotel Owners Academy. Till then, thank you all. Thank you, Darshan. And we'll see you next time, everybody. Thank you.
Appreciate it. Thanks, Mike. Thanks everyone
Thank
for
you.
attending.
Appreciate
Bye.
it.